All right, and we should be live. Welcome to Wealthion. I'm Wealthion founder Adam Taggart here with a special report on the banking system. I'm joined, as you can see here, by John Maxfield and by Joseph Wang. I'm sure know both these esteemed gentlemen. They've both been on this program before. Joseph writes about the banking system and the monetary system, really explaining how the plumbing works over at his website, fedguy.com. John Maxfield is a banking analyst. He has covered the industry for decades, talks daily, weekly with bankers across the country, and writes about that on his Substack, maxfieldonbanks.substack.com. Gentlemen, thank you for joining me on short notice for today's special report. I wanted to produce it because I've had a lot of questions come in from viewers this week about the current status of the banking system. We made it through the earlier failures with Silicon Valley Bank, Signature Bank, Credit Suisse. We had sort of been told that, look, the system's under control here and things should be subsiding. And then, of course, First Republic Bank went down over this past week, and we're now seeing renewed downward pressure on share prices of a number of other regional banks now. So a lot of people are wondering, how many more banks are going to fail from here? So hopefully we can dig into that in this conversation with the two of you. Folks watching, this is a live recording here. So if there are any flubs, just be patient with us. But one of the benefits of a live recording is that I can take questions from the audience here. So I've got some prepared questions for our guests here, and then I'm going to open it up. You can ask your questions in the live stream. We'll try to get to as many as possible. As we kick things off here, gentlemen, just to sort of set the context, maybe Joseph, I'll start with you, and then I'll let you jump in on it, John. How did we get here? What are the main reasons for the recent bank failures? I believe 3 of the 4 largest bank failures in U.S. history have happened within the past 2 months. So something important is going on here. What are the main factors that are causing the current instability? Joseph, let's start with you.
Yeah, so when I take a step back and look at the banks that failed, so let's say Silvergate, Signature, Silicon Valley, First Republic, what strikes me as putting all these banks together so far was their heavy reliance on a very particular volatile sector of the economy. So if you're a bank, what you're afraid of the most is everyone coming and asking for their money back at the same time. Obviously, banks don't have enough liquidity on hand to meet that. And of course, they have some interest rate risks. So if everyone asks for their money back at the same time, well, if they have some unrealized losses on their balance sheet, they can't meet that. But let's be clear, though, when you're looking at deposits, in theory, everyone can ask for their money back at the same time. But in practice, not everyone does. In practice, a lot of people keep money in the bank for a long time. So you can think of that as actually more of a long-dated loan. Now, the problem arises when what you thought was actually a stable and long-dated deposit actually isn't, and everyone asks for their money back at the same time. And I think that's what happened. So if you think about, let's say, Silicon Valley Bank, very high reliance on the venture capital community, which, as we know, in those more speculative aspects of tech, we're not doing well. And so it seemed like that community had a panic and suddenly took money out of all the banks that they had strong relationships with. So Signature, Silvergate, obviously big crypto business, First Republic, San Francisco-based bank, a lot of people in the more volatile tech communities bank with them. And so they had a panic and they took all their money back out at the same time and ran, and these banks, because of that sudden withdrawal, failed. Now, I was thinking that with the end of I was thinking over the past couple of weeks that, this is probably over because we had this localized, I think, withdrawal among that community, and all the banks were otherwise a limited rather than a systemic issue. But now rolling into this week, though, we see something a little bit different. We see all the regional bank shares, as we all know, plunging. And that is giving people a lot of flashbacks to what happened with Silicon Valley Bank. People looking at the share price plummeting, thinking that, my gosh, I've seen this before. People are pulling money out of the bank. There's a bank run, and the banks are going to fail. But that's actually not happening on the ground. Let's look at Pacific West or Western Alliance, for example, a couple of the banks that had the biggest declines. They actually issued statements just a couple of days ago saying that, it seems like there's a panic in our bank stock, but in our own books, in our own deposits, we're not really seeing any significant outflows. In fact, over the past few weeks, they've actually seen inflows. Their deposits are coming back. So there's a big disconnect between what we see in the share price, which there's reporting that suggests significant put positions are building against, kind of like a reverse squeeze that we saw during the AMC meme stock phase. And that's coloring a perception that the banking crisis is getting worse, and everyone is going to be not good, when on the ground these banks are telling you that we don't really see big outflows. So I think that's where we are now. There's this big, I think, difference, a big divorce between the what's actually happening on the ground and what we're seeing on the screens of the market. And that's very dangerous, because someone who is not very attuned to what's happening on the ground could look at a share price, get spooked, and actually go and take their money out. That is to say that price action can actually shape narrative and create a crisis where there otherwise would not be one.
Okay, and just on that point there, you know, a bank run, if big enough, could take down any bank, right? Right, and so you're saying that the risk here psychologically is that people think, you know, there's a fire in the theater when there isn't, and everybody runs, and you get, you know, casualties when it didn't need to happen.
Exactly. And I'll just note there's reporting from the Wall Street Journal that's showing that there's all-time high put positions building against, let's say, Pacific West and Western Alliance. Now, that's to your example, Adam. That's like buying insurance on someone else's building and then burning it down. So that's a very dangerous situation. So no, that's not what we want to happen. Western Alliance, these are so far, based on what they've just announced to us, they're functioning. They're making loans to American businesses. They employ people. We want businesses that function, that are working to survive, give jobs, gives credit. We don't really want to destroy them, just so some speculators can make a little bit more money.
Okay, so there are two other factors in play, and John, I'll let you maybe address these in your answer. One is that you know, banks are in the business of borrowing short and lending long, and they have, you know, for years have been buying bonds, which is sort of a form of lending long to the government. And with the recent extreme interest rate hikes that the Federal Reserve has pursued, they're now underwater on a lot of their treasuries, at least, you know, in many cases, their treasury bonds. And these are generally sort of safe, what are called money good assets. And if you're underwater in them, and you can wait until interest rates, you know, readjust and the prices come back, you'll be okay. But of course, in the case of Silicon Valley Bank, for example, you know, there were just way too many calls on deposits, and it had to turn those unrealized losses into realized losses by selling them to pay those depositors who were leaving. So we do have that pressure on these banks, right? Is that their loan books, or their bond portfolios are underwater in a lot of cases. But secondly, you know, more and more depositors, not just big players like the VCs that were parked in Silicon Valley Bank, but just regular people, are really beginning to wake up to, like, wait a minute, like, I can get like close to 5%, you know, in a money market fund through my brokerage, or by buying U.S. Treasuries. And my bank, you know, in many cases, a lot of banks are still paying, you know, almost zero, or, you know, a pittance basically. And deposits are starting to walk out the door that way. I want to say I saw a stat that was pre-First Republic that something like over $1 trillion in deposits had left the smaller banks, smaller being kind of any bank that's not in the top 10 bank, the way our banking system is overweighted here. So how serious is that threat to the banks that remain? Is it just an inconvenience, and it's just a, you know, inclement weather that they can just hunker down in and get through, or will that, you know, potentially cause some of these other banks to get into real trouble?
So Adam, let me start a million miles up, and I'll zero in real quick to answer it. So I'll answer kind of both the first question and the second question.
Great.
Kind of quickly. So why is this happening? What's going on? You know, all that. So like, let's just start all the way up. So like, there have been 9 major banking crises since the beginning of the United States. and like dozens of minor banking crises. Okay, so crisis is as odd as it sounds, like kind of the exception, not the rule in banking. Okay, and so like, and if you look at that on an institution by institution kind of basis, there have been 17,000 plus bank failures since the beginning of the country, 22,000 mergers and acquisitions. Let's say 4,000 to 5,000 of those are mergers in lieu of failure. So you're looking at failure is actually, and we have less than 5,000 banks today. So failure is anywhere from 4 to 6 times more likely in the banking industry than is survival. So again, like these, even though in these periods they seem really unusual because they're short and very acute, it's actually a pretty usual thing in banking. And so then you say, okay, well then what causes these intermittent panics, right? And if you go back and you study all through time, it's the same thing each time that causes these panics or these crises. And it is, you see a huge surge of liquidity. And I call it novel liquidity because that means that, because there's 2 different types of liquidity. There's liquidity that can kind of slosh around within the system. So they can go from like, a bank account at Bank of America to say like a money market account at say Charles Schwab, right? So it's not necessarily in the banking system per se, but it's within it's within the financial system kind of writ large. Okay, so that's just a regular liquidity surge. A novel liquidity surge is when you have liquidity come into the system, and that can come in 2 different ways. It can come in from another system. So in like the late 1800s, like the 1870s to the early 1920s, you had enormous amount of liquidity coming into the United States system from the European system. Okay, and that kind of peaked in World War I when we're like sending all this produce over to Europe, feeding their armies, and they're sending money back into the United States. So that's a novel liquidity surge that comes from one system into another system. Another type of novel liquidity surge is when it comes up through the ground. And Adam, you'll be very familiar with these. These are like Federal Reserve. This is just when like money is just like created out of thin air, right? It's like a geyser coming out from the ground, right? So you go back to the very beginning, and what you see is you have these novel liquidity surge, and you have surge, failures, surge, failures, surge, failures, surge, failures, and I'm just talking like all the way through to today. So then you look back and say like, okay, well, what's going on in the economy right now? Well, what happened 3 years ago, 2 to 3 years ago? Well, we had the coronavirus crisis, right? And what did the government do in response to the coronavirus crisis? An enormous amount of fiscal and monetary stimulus. So that's basically just a novel liquidity surge, right? Just coming up through the ground like a geyser, right? And so what happens in that situation is it throws the whole system out of equilibrium. Now, like it's not like the system is ever like totally in equilibrium, but it's always kind of moving toward or away from equilibrium. But when you do something like that, that accelerates that position of where you are in relation to equilibrium, everything kind of gets thrown off. And so that's kind of where we're at right now. And so what you have there is then you have all this extra money just dumped on the heads of these banks. And they say, well, like, what are we going to do with all this money? You know what I mean? And you go to the very tip of that spear. And who's at the very tip of that spear? Silicon Valley Bank, right? And Silicon Valley Bank, because they are doing like the VC stuff. So all the most like the cutting edge type of investment stuff. And they're holding all the cash for those companies. So they go into the crisis with $60 billion in deposits on their books. And then by the end of, I think it was last year, I think they had $190 billion in deposits. So they get $130 billion in deposits just get dumped on this bank's head, right?
Basically triples within a couple of years. That's
exactly right. So these guys are looking around like, what are we going to do with all this money, right? And they say, well, let's be real safe. Let's not do anything crazy. Let's put it in the safest stuff that we can think of, right? Let's put it in treasuries, and let's put it in. And I think Adam, what you like money good, they're like money good bonds, basically, right? And let's put it in treasuries, and let's put it in mortgage-backed securities that are guaranteed by the government, right? So they go and they do that, but they do it at a time when interest rates are basically at zero, right? So this is again to your point about the bonds. So they do it when interest rates are zero. Well, when you do it when interest rates are zero, that means your bond prices are basically as high as they can get. So when you do that, and then the Federal Reserve comes in and raises interest rates, well, bond prices plummet, right? And that causes the Silicon Valley Bank, their books to basically go underwater, right? So then you have these group of people who are out there saying like, oh, like this is a problem, right? Because 95%, or I think it's something like 95% of their deposits are uninsured. So they're thinking like, oh my God, like we're going to lose all of our money. So then that starts that run, right? So that's really, and then everybody is then tuned into what's going on there. Everybody's like, oh my God, like there's these runs on these banks. Like we don't want to lose all of our money. So then other banks that are kind of similar, that share similar characteristics. And in this case, it is exposure to cryptocurrency. So that's why your signatures, then went down. And then you also have concerns about uninsured deposits, a large percentage of uninsured deposits. And then in the case of First Republic, you also have the unfortunate similarity of the customer bases. And so you have all those things come together. And so those banks then go, but then then you enter this time period where everybody is acting irrationally and everybody is concerned, right? Everybody's concerned about just getting their money. And so that's a true panic, is when you're in that situation. And that's kind of the situation that we're in right now. And so when then you go out and you look at, the bond books of these banks right now. And yes, theoretically, a lot of these banks are underwater because, the interest rates shot up so quickly that caused their bond prices to go down so much, and they're underwater. But the fortunate thing is that the way the accounting works in banking is that you can take bonds and you can put them in two different buckets. One of the buckets is available for sale. And those are ones where you have to mark those to market when the market price of those changes. But the other bucket is called held to maturity. And so long as you do not have to raid that other bucket, the held to maturity bucket, you do not have to then sell it to get liquidity to satisfy depositors. You do not have to mark those bonds to market. And so because you just sit on those and you just wait till they mature, and then you sell them for the par value, right? And so but these are nuances. And in times of irrationality, you cannot expect people who are not, accountants in the banking industry to appreciate and take the time to understand the nuances. And so that's kind of where we're at right now. And that's kind of where all the fear is kind of leading right now. And so, the banks that are having issues right now, those are the ones that are lots of uninsured deposits and where there's concern about the valuation of their bond portfolio.
Okay, so somewhat similar to what Joseph was saying, you're kind of saying right now the biggest threat sort of is fear itself, right? It's the herd being spooked, may do things that may not be completely rational given the reality on the ground, but if they do it anyways, it then actually creates more instability that could create a real issue.
I'll add one point to
do.
John's point. So, like John mentioned, so First Republic, similar client base to Silicon Valley. There's actually another bank in that area that had some of that similar client base. It's Pacific Western. Of course, not as much, but some overlap. In their earnings report, they had a very telling slide. So they lost deposits, but when they broke it down, they said they had 10 billion deposits from the VC community, and half of them left in March. So again, you can see that it's very much part of that client base, part of that community that had some kind of a panic. But Adam, I'd like to address one of the questions that you raised that I think I hear a lot, but I think it would be helpful to comment on, and that is that we see overall deposits in the banking sector decline, and we see a rise in money market fund assets, and there's often a perception that, oh my God, all these deposits are leaving banks and going into money market funds. How are banks going to survive? They can't pay those high interest rates, right? Now, that's really a big misunderstanding of how all this works. So if I take money out of a bank and then put it into a money market fund, that money doesn't leave the banking sector. Now the money market fund has to deposit. So, it's kind of a quasi-closed system, unless, of course, the money market fund lends to the Fed, which on average, that amount it's the RRP amount, hasn't been changed that much. What's really been driving declines in overall banking system deposits is actually quantitative tightening and also changes in the securities portfolio of banks, as well as changes in the TGA. Now, these are all technical factors, but overall, I think the takeaway would be that the level of deposits in the banking sector is dependent on many factors. You individually, it's not because everyone is running to a money market fund, then the money market fund just has the cash and they have to do something with it. And to the second point about whether or not banks can afford to compete with money market funds at, say, 5%, I think that really misunderstands how deposit rates are set. So if you're a depositor, so let's just look at the history over the past few decades. Over the past few decades, Fed has hiked rates up and down, but deposit rates, savings account rates have always been very low. This is because that banks don't purely compete on deposit rates when they're funding themselves or when they're attracting customers. They can offer things like a toaster, or payment services for a business. Say you're a business, every month you have to pay employees, lots of ACH, lots of wire transfers. A bank can offer that as a service rather than offering higher rates. And of course, a lot of people are just like the convenience and don't really care about interest rates that much. So even as interest rates go up, the deposit beta, that is the amount of interest rates the Fed offers passing through to depositors, has always been, maybe at most 40, 50%. That's totally historically normal. There is really no problem for a bank to be funding itself. We've had many, many rate hike cycles, so this is not something new.
Okay, that's actually really useful, grounding perspective there.
Adam, do you mind if I just build one more point on that?
Please do.
So Joseph is exactly right. But there's one thing, 2 points on that. The first point is that, so Adam, and you had asked kind of about the smaller banks. Is there concern about the smaller banks losing all their funding because of kind of what's going on right now? And that would be kind of a function of the implicit government guarantee of the large banks, of all the deposits at the large banks, right? Whereas there isn't that same implicit guarantee at the small banks. Well, one of the things that's interesting is that, and Joseph kind of touched on this, that over time, there has been a stickiness in deposits at all banks, right? Because it's like not easy to change your banking relationship, right? You have direct deposits coming in, you have automatic bill paying going out. And so you have it's not like just as easy as just pressing a couple buttons and you can switch your banks, right? And so what we've seen is that in previous rate hike cycles, the smaller community banks, they had somewhere between 3 to 6 months before when they had to start actually increasing their own rates on their deposits to match what was going on in the market before they saw any attrition. So before they saw customers leaving their banks to go elsewhere for higher rates. And what's interesting is that I've talked to a number of different rural bankers in the past couple of weeks, and they said that this is the first cycle that they have noticed that there is an expectation that they hike their rates much more quickly than they have in the past. And so they said, and I was talking to a banker in Nebraska, he said, basically it was almost immediate. As soon as those rates went up last year, and then they didn't raise their rates, they did see deposit flight. So that is different this time than last time. You say, well, why is that? One of the reasons is because the rates went up so fast, right? I mean, they basically went from 0 to 5%, right? Almost immediately. So you're sitting on if you're sitting on $100,000, $200,000, $1 million in deposits. I mean, the opportunity cost of not moving your money is actually pretty high. That's the first point. The second point is that,
and sorry to interrupt, but that's like the frog in the boiling pot analogy, right? Where normally the heat gets raised slowly, and so the frog never jumps out. But if you raise it too quick, the frog jumps out of the pot, and that's what's happening here. Is the depositors are saying, "Oh, wait a minute, I can see the difference. So let me go over there." Yeah,
I'm going to steal that because that's really good. Okay, because that's a perfect way to describe it. But the second point is that, so if you break down deposits and deposit betas by the type of deposit it is, so you have consumer, you have commercial, and you have high net worth. Well, one of the things, if you look at consumer deposits, actually they go up and down a little bit here and there throughout the years, right? But like they really you haven't seen the betas on consumer deposits go up that much, right? Presumably that's because like the size of those accounts are not so large that you'd be thinking like, I'm missing out on like tens of thousands of dollars or hundreds of thousands of dollars not switching my account to get 5% as opposed to 1%, right? But you have seen a huge change in commercial deposits. The betas on commercial deposits have gone way, way, way up. And you've also seen an increase in betas on the high net worth deposits, right? So where the opportunity cost is much higher. Well, if you go to your small banks around the country, what is the predominant share of their deposits? The predominant share of their deposits are consumer deposits. And so that is, so there's things that cut against it and things that cut in favor of these smaller banks. The things that cut in favor is that largely consumer, as less commercial, but things that are cutting against them is that because of the magnitude of the hike, people are more aware of kind of like the differential. And so you have all these kind of things that are kind of going on at the same time.
Right. One point I'd add to that, smaller banks are also much higher percent of their deposits are insured, right? They're smaller clients, more mom and pop like. So that's another thing. There's less of a reason to panic because those smaller banks, they don't have as many uninsured deposits.
Okay, and let's talk about insured versus uninsured for a second. So those words used to mean something, right? If you had insured deposits and the bank went under, you would get all your money back, or sorry, up to the FDIC limits if you were insured. But if you were uninsured, you wouldn't. You'd have to take a haircut. So far, the uninsured depositors haven't had to take a haircut. I'm actually not super up to speed on the First Republic details right now. So correct me if that's incorrect with them. But, I think there's a narrative going on right now that, I guess all deposits are going to be insured going forward from here. Would you disabuse listeners of that? And Joseph, will let you continue.
No, I agree with you, Adam. I think that the public policy response this time has been a lot of, strongly suggesting that all deposits will be guaranteed. So I think the authorities, the Fed, the Treasury, are very concerned about the banking sector, and so what they're strongly suggesting, and Chair Powell was basically gone on, during his press conference and suggested that the treatment that they gave Silicon Valley depositors, which were all made whole, is going to be the playbook going forward. So technically, in able to have full deposit guarantees, you need an act of Congress. But once a bank goes into receivership, the administration has all sorts of emergency tools so they can actually honor that implicit guarantees. I think that's the playbook going forward.
Okay, John, you're nodding through this, and people can actually see that now, so it's nice that I don't have to tell people that. Is this just? Here's the question I have, and of course, there's a moral hazard aspect potential that we'll talk about in a second. But is this just magical thinking? I mean, how do we go from a system where we say, all right, we're only going to insure a certain percentage of bank deposits to, all right, Oprah, everybody gets a car, right? Everybody's insured. Right? Could we always have done that? Why didn't we? Do we actually have the money to do that? We've always heard that FDIC will insure accounts per bank, but there's only so much money in the FDIC insurance pool. And if every bank were to go under, it would exhaust that immediately, and most folks wouldn't be covered. Are we just thinking magically here, or does the math pan out somehow?
Well, I would say, and Joseph, you may know more about this than I, but this is one of the hardest questions really in banking, because on the one hand, so if you go back to pre-FDIC insurance, right? I mean, there were panics every single decade. Sometimes there were panics multiple times a decade. And then after those panics, you'd have depressions. It was very serious depressions. 1857, there's a panic, serious depression afterwards. 1873, major panic, serious depression afterwards. 1893, panic, serious depression afterwards. Then those three depressions were on the same scale as the Great Depression in the 1930s, right? And so the idea with bringing in the FDIC insurance is to stop the panics, and hopefully to stop the panics, you'll also stop these depressions, right? And so we saw that, right, in the wake of the Great Depression. There's this long period called the Great Moderation, where there weren't a lot of bank failures. The bank growth was relatively pedestrian. Bank profitability was relatively pedestrian. But then it all kind of changed again in the 1970s, when you had this younger generation of bankers who weren't alive during the Great Depression, who weren't scared, who that didn't impact kind of their risk appetite, right? And so then we have the failures again, but at that point we still did, even though the deposit maximum, there was still a cap, they still did insure basically all deposits. But then that changed in 1991, because that's when we came in after we had a whole bunch of bank failures during the 1980s during the S&L crisis. Then there's a CRE crisis that impacted this commercial real estate crisis that impacted your commercial banks. So then, and the Congress came in and said, whoa. If we insure all these deposits, the FDIC is going to go broke. So then they changed the law in 1991, where they say to the FDIC, no, you have to do an assessment on, whether or not, the risk that this does to the DIF, right? And when that law changed, the FDIC stopped insuring deposits up to that 100% level, regardless of whether that limit was. So these are smaller failures that impacted. So it isn't only until just recently that this has come back up. Well, I mean, it came up in the financial crisis, if you remember, with IndyMac, right, where they were like, we're not going to insure all those deposits. But then what happens then, right? What happens then when the FDIC comes out and says, we're not going to insure all the deposits? You have runs on these other banks, right? So you have these two things that the FDIC they're charged with protecting the deposit insurance fund. But if you insure up to 100%, is that protecting it? Maybe, maybe not. But if you don't insure and then you cause additional runs, is that protecting it or is it not? So the problem is like it's not an easy answer there. Like regardless of what you do, you're kind of screwed either way.
I think that what we've seen so far, and I totally agree with John, is that policymakers are not willing to accept the risk of a greater banking panic. So even if you have, in theory, limited deposit insurance, or if you look across in the Eurozone, you have, in theory, bail-ins where investors in the bank would take a loss. They don't want to run that playbook. They're afraid that there might be greater contagion. So in practice, it seems like they're rolling out a policy where everyone gets to be protected. Now, there's some reason for that. Obviously, you don't want panic, but let's say you're a depositor. Do you really have the responsibility of seeing whether or not your bank is doing every day? You have no way of knowing that. So maybe it's not right to allocate that responsibility to you. So I think that's probably going to be more of a policy shift going forward. Just guarantee all deposits.
But the other thing to keep in mind is that, so if you think about the dynamics of how banking works, if you just say like, okay, like every single bank is insured up to whatever limit, it literally opens up your federal government to an Ireland type of situation, right? With that we had in like 2010, right? It was a 2009 or 2010, where it's like they have these huge banks that can literally, I mean, you can grow a bank because of the supply and demand dynamics of banking, because there's an unlimited demand for credit, right? If you price it low enough and you set the terms easy enough, literally the demand just goes straight. It goes parabolic. It goes straight up. That means you can grow a bank as large as you want. I mean, you can grow it from $1 to $1 trillion basically as quickly as you want, so long as you have access to funding, right? So by opening a government up to completely backing all the banks, or basically saying that ahead of time, you're basically opening a bank up to saying like, okay, like little bank in like little Springfield, Wyoming, or Springfield, Colorado, like you basically get to say whether or not the government of the United States is going to, I mean, assuming that the regulators aren't doing their job. I mean, this little bank could basically break the United States government. I mean, that's the concern and around protecting all deposits.
But I think there's also a cultural change. I don't think the government cares about how much money they spend anymore, right? So to your point, Adam, how do we afford this? How do we afford anything, right? We'll just go and borrow it. That's kind of how we operate the government now.
Okay. I think you guys are really depressing a lot of the viewers here. Okay. So, I mean, this is, I'm going to say this, you guys don't have to put it in these words, but I mean, it does seem to be sort of magical thinking time, right? Where it's just, okay, everything's protected. Risk really doesn't matter. Of course, this then opens, more moral hazard in the sense that, like, yeah, okay, shareholders and bondholders of these banks are getting wiped out or whatnot. But if you're an executive and you kind of know that, all right, well, I can sleep at night knowing that 100% of my depositors will always be taken care of, I'll just take as much risk as I can and hopefully win and get massive bonus payments and stuff like that. But if I lose, whatever, I go on to the next thing. Depositors are okay, right? You guys are nodding as I'm saying this. So, I mean, I guess let me ask you this. Are you concerned about this policy? Does it concern you as someone who's just a stakeholder in the long-term sustainability of the U.S. banking system? Do you think this is a good policy or a bad policy to potentially now blanket cover all depositors?
Well, I mean, I would say that like either way concerns me. I mean, I'm not a doom and gloomer. Let me be very clear. I'm a pretty optimistic guy. You know what I mean? Particularly when you live in the United States, you have every reason to be optimistic. You know what I mean? Like you look at the growth, you look at the land that's in this country. I mean, like we have a pretty good situation here. So I don't want this to sound doom and gloom, but like whether you insure, there's problems if you insure them all. There's problems if you don't insure them all. You know what I mean? It's just a matter of like, and that's why really, I think probably the proper solution is you have to, and again, this isn't an necessarily ideal bulletproof solution either, but you've got to go on a case by case basis. You've got to, the people on the ground have got to have there's got to be built into legislation flexibility to make the right decisions depending on what the facts are at the time.
Okay. And it sort of sounds like that's what we're doing at the moment, where at least Powell hasn't come out and said, oh, there hasn't been an announcement yet that says, yes, everybody is 100% going to be protected all the time. They're saying we're going to do it on a case-by-case basis, but in the recent cases, they're applying this. So it kind of de facto is what's going on right now. I would guess they could change it. But I don't know, Joseph, you're nodding through all this.
No, I totally agree. But I'm a little bit, I totally get the moral hazard intuition. So if your depositors are all guaranteed, you're basically borrowing with a government subsidy, and then potentially you can do more riskier investments. Great, they turn out great. Big bonuses to executive. And if they don't, okay, well, government will take care of everyone that I borrowed from. But that's my sense. But then I think you have to keep in a couple of things into mind as well. So there's a lot more regulation on what banks can buy, capital regulations, for example. So it's not as likely that a bank would go and make these high risk, high return investments. They are a lot more regulated. And the second thing is that these execs usually have tremendous amounts of compensation in stock. So if you're a Silicon Valley Bank exec with a lot of stock, well, you kind of got wiped out as well.
Right. When the music ends, but while the music's playing, you're selling your stock grants as you get them, right? You can still.
Oh, that's a perfectly good point.
Well.
I think there were some reports that insiders were selling their stock knowing how it was going to go. So that should be clawed back. That there has to be some response to that.
I know that question was raised earlier. Do we know if anything was clawed back from Silicon Valley Bank yet?
I don't know.
Okay.
I think it's worth noting that I believe the CEO of Silicon Valley Bank was one of the board members of the San Francisco Fed, which is one of the regulators. So you have some angle there. Is it possible that they got preferential treatment? Obviously, the Fed was aware that they were not managed well, but did they kind of turn a blind eye because, my gosh, the CEO is on the board of directors? So we have to look into that as well. There's some governance issues there.
Right. And you were just talking a minute or two ago, I was going to bring this up about, well, these banks are regulated and folks are going to make sure, but it's kind of like, well, the regulators kind of missed, the vulnerability, at least of these West Coast banks here. And, the CEO of Silicon Valley Bank being on the board of the regional Fed out here in California sounds shocking, but then, and it might have been you, Joseph, but when it was explained to me, it was like, it's actually not that uncommon because he's one of the largest banks in the region. It's kind of how the system's structured. It's a feature, not a bug. But let me ask you this. I've seen questions raised recently like, look, Mary Daly, who's the president of the San Francisco Fed, her batting average is pretty terrible this year, right? Like, I mean, how culpable or responsible is the San Francisco Fed for not raising more warning flags about the banking dominoes that are falling in its territory right now? I'm going to direct that to you, Joseph, first, because you're Fed guy. But
okay. So, like you mentioned, Adam, Mary Daly's batting average isn't great. She seems like a nice person, but she was on team transitory. It kind of failed at monetary policy. The other job the Fed has is banking regulation. Well, listen, where are the bank failures? First Republic, San Francisco based, Silicon Valley, in California. And so, she's not doing very well on supervision either. And it seems like there are Fed presentations that suggested that she had a reason to know. So it doesn't seem like it's the right job for her. But here's the thing that I've learned working at the Fed is that they never fire anyone. And so because of that, nothing really matters. You can just do whatever. And then, you still have your job and maybe you even get promoted. I mean, Lil Brainerd, obviously a terrible call on inflation. Now she gets to be promoted to be head of the something economic, whatever. So, that's the thing, because we have a system that doesn't penalize failure and doesn't reward good judgment. The Fed or organizations like that can't improve. They can't grow and they can't learn. So I'm thinking that everyone who made those bad calls still works at the San Francisco Fed, still contributing their bad judgment. And that's not good for us as a country, I think.
Yeah, you're putting your finger right on the open sore of worry that a lot of our viewers here have, right? Which is, you have a system that in some ways allows insiders to take a lot of risks, get unfairly compensated for, kind of gets to socialize the losses, and it's being run by people that you say, it's not really a self-learning operation. And so, I mean, maybe you're just stating reality, but it is concerning because, of course, it seems to always be that the bad actors don't get punished. In fact, they can, leave having lined their pockets. The people who are supposed to be overseeing don't really get accountable for oversight mistakes. And yet it's the taxpayer or the depositor that has to pay the ultimate price of cleaning all the mess up. So anyways, maybe I'm being a little bit too doom or gloomy here. John, I'll let you comment anything on there, but let me ask you one last question before we open this up to Q&A from the audience, which is, you talk to banking executives for a job. How worried are they? From at the beginning of this conversation, you guys were sort of saying like, look, it looks a lot worse than it is. It's probably going to blow over. You just said we've seen this many times in history when we have these liquidity spikes. This is all kind of natural. Everybody, don't freak out. It's the freak out that could do more damage than anything else. So are these guys just hunkering down and they're not too worried, or are some of these guys worried?
Well, I would say that, so to answer the first question first, so like, sure. In terms of like the looking at the people at the Fed and kind of what happened at the San Francisco Fed, like I'm of the belief that like, if I was in the job, I'm not sure I would have done it any better because it's just a really hard job. I mean, I think we just have to like be honest and say like what they're doing. It's not like there's a playbook where it's like you do A, B, C, and D, and then like E is the answer or F is the answer, and then they just missed B. You know what I mean? The problem is like all of these things are brand new, right? Even though we've had all these crises in the past, each crisis does have its own unique peculiarities. And in dealing with monetary supply is extremely, extremely hard. And anybody who says it, they just do not understand how this stuff works.
Can I just inquire for a second here? So I get it. It's not, it's not super easy, and every bank is idiosyncratic to a certain extent. And yeah, like you said, sometimes you're inventing the playbook on the fly. That being said, let's look at Silicon Valley Bank, right? They had a hyper concentration in a few very rich depositors, right? So just simple math says, okay, a few of those guys go, you start getting into trouble, unlike a Midwestern bank that has just a bazillion small retail customers. But then back to our frog in the boiling pot of water, the Fed knew it cranked up the heat, right? And so what it should be doing, I would think, is looking at the books of its banks and just saying, okay, who's vulnerable to being really underwater, because of our policy shift, right? And are people at least putting interest rate hedges in place to make sure that they've got some buffering against this? And Silicon Valley Bank was both vulnerable on its loan book, but did no risk management on the interest rate hedging side of things. So is that something that a decent regulator should have noticed?
Well, one of the ironies in banking is that like the darlings in one era are almost always the pariahs in the next era, right? And it's like, I mean, you go back 4 years, Silicon Valley, I mean, like this thing hung the moon. Everybody thought like, oh, the customer base was amazing because it gave them all this low cost deposits. I mean, they basically paid nothing on their deposits because the requirement of these customers that they had in there, they're basically like, yeah, you can be our customers and we'll open up all these doors and do all these things for you. But like, you got to leave these things basically the functional equivalent of a checking account. And so like, I mean, the returns on this thing were just flying high. And then when you had all this money come into the economy from the coronavirus crisis, where did that money go? It went to that sector, right? You remember the IPO boom and all the stuff that was going on at the time. I mean, Silicon Valley, I mean, everybody was like, it was like everybody wanted to do exactly what they were doing, right? And then all of a sudden it flips. It's the same thing with kind of all these other banks that are having all of these issues. It's like the business model of the past decade that everybody kind of worshipped in the banking industry was what? You had a low-cost consumer deposit base, and built on top of that, you had a commercial finance engine, right? So you get the yield on the commercial finance engine, and then the low cost of the deposits. And that was like, I mean, they were making more money than anybody. Everybody thought that they were like the best banks ever to come about in the banking industry of all time, right? Well, it turns around, like, it turns out that's not that good of a situation, right? And so it's like, and everybody buys into this stuff. The regulators buy into this stuff. The people in the industry buy into this stuff. The people that are reading the news, everybody kind of like drinks the same Kool-Aid, right? And so it's like, you look at the regulators and think like, yeah, clearly they didn't do the right thing, right? And you can look at that from a variety of different angles. Like they didn't do the right thing. Like they should have come in and said like, Silicon Valley, you should not be taking those deposits on your balance sheet. Like, what are you going to do with the $130 billion in cash? Like, what are you going to, you only knew how to do with $60 billion. And of course, it was 18 months, you got an additional 130. Like, you shouldn't be taking that onto your balance sheet. But like, we had never, ever, ever seen anything like that. We've never seen anything like that surge in deposits in a single organization, like particularly one that was considered to be a marquee institution in the industry. So it's like, I mean, you could see where it's like, you're just like, it's a hard situation, I think, to kind of judge what the right thing or wrong thing to do in the moment.
Yeah, it is. And I get what you're saying. Although, of course, what you're saying is look, it was unprecedented because we'd never had such a massive liquidity spike, before, especially during a national pandemic. But of course, the liquidity spike was largely due to the Fed's policy response to the pandemic. So that the Fed both created the liquidity spike and then created the inflation, which then made it right. So the Fed has been the cause of so many of these things.
No, I'm going to have to defend the Fed a little bit. Just like John mentioned, they didn't have to take those deposits on their balance sheet. So I'll use another bank as an example. JP Morgan, a lot of Fed liquidity, a lot of people wanted to deposit money at JP Morgan. JP Morgan said, no, actually, you can go put it in a money market fund. And the money market fund then takes that money and puts it into the RRP. So basically, it takes liquidity out of the banking sector. And Silicon Valley Bank could have done the same thing if they did not want to. But then if they did that, they wouldn't be able to earn so much money, right? So it's kind of their choice there.
But Adam, to your point about like, it was also the Fed that kind of fueled this, and which is exactly right. That is exactly right. But like, you think about like, now let's go back to March 2020, April 2020. What did we see? We saw a 30% annualized decline in GDP. We didn't even see that in the Great Depression. I mean, like,
right.
This is so far beyond anything. So it's like all this stuff, you go back, all these different ways, you're like, hell yeah, you want to get in strong on that because you don't want a Great Depression. You certainly don't want that. You know what I mean?
Yeah, no, I'm sensitive to the fact that they were freaking out with the rest of the world at that time. And, you never know what the implications are going to be of big decisions you make in a crisis like that. All right. But real quick, because I do want to take a few questions from the audience here. Two last questions for you guys. I'll start with you, John. You both can answer them. How worried are bankers? And then the second question is going to be, do you expect many more banks to fail from here, or are today's worries maybe a bit overblown?
I think that the worry of bankers is on a continuum. Some are very worried, some are less worried. And that's a function of where their deposits come from. Are they largely commercial? Are they largely uninsured? So I'd say it falls in that same continuum. And then in terms of like whether more banks are going to fail, I mean, I don't like to come out and say like yes or no. I think there are going to be some, or there aren't. Like, I would not be surprised if there were, and I would also not be surprised if there weren't. But if I were to kind of fall on one side, I'd say that we'll probably see a few more. That would be my guess.
Okay. I don't want to put words in your mouth here, but it sounds like you're not afraid of like, just sort of like a out of control cascade of failures through the banking system here. So yes, there may be a few more failures from here, but you're not expecting like oh my gosh, the banking system's really vulnerable here.
I think if that were to happen, I think the Federal Reserve would open up the floodgates, and I think there'd be so much liquidity dumped into the system that they would stop that from happening. That's just my analysis.
Okay. Joseph?
So I think there's a big divergence between what we see in the prices and what's happening on the ground. So again, what's the banks that are most in the news right now? Let's say Pacific West, let's say Western Alliance. You look at what's actually happening in their business, they're telling you that they don't actually see any change day to day. But their stock prices are tanking because there's a lot of speculation, it seems. So right now, from my perspective, it seems like the actual banking sector is stabilizing and, it should be fine. But if we keep seeing all these scary headlines, these price declines, that's going to panic people. So whether or not this gets worse or gets better is going to have to depend on public policy. A couple of things that have been whispered. One is just even stronger deposit guarantees for everyone, such that even if you're seeing your share price of your bank plummet, you won't want to run anyway. Or today, I think there's some whispers of a short sale ban. Now, I think so. first of all, I don't like short sell bans and all that stuff, but I think a bank is kind of special in the sense that you don't actually know what's going on in the bank. So if someone if some investor can just easily impact the stock price of a smaller bank and create the perception of panic and profit from that, and basically destroy something that was otherwise healthy. So there's whispers of that, and that could also stabilize what we see now. My sense is that when you panic the policymakers, things get better, and they are panicked right now.
Okay. All right. Well, look, I'm going to take some questions here from the audience. So folks, just ask your questions here in the live chat, and I'll pull as much as I can. One I've seen that's come through here is, what are your thoughts on commercial real estate loan exposure? So the really big banks tend to own more of almost every other loan type except for commercial real estate. That's much more over-owned in the regional / smaller banks. A lot of concerns about potential defaults on those loans. So could that be something where the stool is a little wobbly, but not so bad, but then all of a sudden somebody kicks out one of the legs, with commercial real estate loans if they start defaulting? Like, how big of a risk, additional risk, do you see that to the banking system here? Jonathan, let's start with you.
I would say that, so commercial real estate, I don't think, commercial real estate isn't just like some big, you can break it down into different types of commercial real estate, right? And I think the concern is that within the office portfolio, and that's for a variety of reasons. And so, but office is not an insignificant amount of bank balance sheets if you look across the entire industry. And so I would say that there is concern in office. And it's funny, I was just talking to a banker who's like really dialed into this stuff yesterday. And he was saying that for up until basically this week, they had not seen much capitulation in among the sellers and among the sellers and trying to drop the prices down. They were kind of holding tight to where they were at. But he said just the last week or two, they started to see capitulation among office people who own office properties and selling them at a significant discount. And he was referring specifically to San Francisco, which is like San Francisco is kind of like getting everything right now. You know what I mean?
Yeah, it's getting kicked while it's down. Yeah.
And he said he said he hadn't seen as much kind of on the East Coast yet. But there is concern, and I think the concern in office is a legitimate concern.
Okay.
I agree with John, and I'm going to defer to him on his observations. He has much more conversations with bankers. But I also make another thing that I don't think people are taking into account, is that real estate prices, even commercial real estate prices, have gone up a lot over the past 5 years. So let's say you made a loan 5 years ago, say 50% loan to value. Over the past 5 years, inflation has pushed up a lot of things higher. Now, of course, office is going to be in big trouble, as John mentioned. But if you look at everything else, let's say multifamily, let's say malls and stuff forth, 5 years of high inflation, that's going to help your loan to value. It's going to push it lower. So if you're a bank making a loan against that, you have more protection because your borrower has more equity in the deal.
Okay. I guess just before we hop off this, because I'm seeing lots of people comment on it, is your general outlook on the banking system is like, it's really not that bad, guys, right now, but if commercial real estate defaults really pick up, different story? Or I don't want to misrepresent your level of concern here, but I just want to clarify it. So back to you, John.
Well, I mean, let's keep in mind that all of this is coming in the wake of the financial crisis not too long ago, which was in large part the thing that caused a lot of the smaller bank failures was commercial real estate. And so that a lot of these people who run these banks today have been careful in terms of like the loan to values on the commercial real estate and the collateral and all those types of things. So like the risk, there isn't as much, my assessment is that there isn't as much risk in commercial real estate overall, but there is in this one pocket in the office space, there is risk in that office space, but that is just one piece of a much larger mosaic. Okay. Mm-hmm. So this is not like a situation like 2008, 2009, where you're going to have like hundreds of banks fail because of commercial real estate. But this is some where you're going to have, if you have some that are focused in the office space, they could seriously, they could face some serious issues.
Okay. So if you are invested in a regional smaller bank, it might not be a bad idea to try to find out what their exposure to office space is.
Sure, sure. I mean, and well, the other thing to keep in mind is like if you're an investor, it's times like these that you buy bank stocks, okay? Because it's like a bank is you're up against a fixed return schedule. Your typical bank, a good bank will earn 12%, 14% of its equity just every year, just bang, 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 bang. That means if you want to juice your return onto that, it's the price that you pay that really matters.
Mm-hmm.
So if you're an investor, like what I would say to investors is like, don't be scared at a time like this. Like go out, look at your really good banks, your US banks, your M&T banks, your PNCs, and like those things get real low. Like it's not a bad thing to consider putting some of that in your portfolio.
Okay, and I'm glad you mentioned that because in your intro, I had wanted to ask you this question, which is this the time to be greedy when others are fearful, right? You guys sort of seem to say, hey, the fear of the crowd is kind of in the driver's seat right now, and maybe things really quite aren't as bad on the ground as the headlines are making things seem. So while share prices are becoming collateral damage of that fear, you may be able to really scoop up some good values here. I actually did a Twitter poll last night where I just open question, ask people, hey, you know, what assets that are unloved right now do you think, you know, will be in demand again soon? And people were putting up, what was it? Was it KRE? Is that the ETF that invests in the regional stocks? That was a pretty popular one that folks were suggesting. Sounds like you think something like that may actually be worth considering, given what's going on right now.
Don't buy anything. You don't go out on a limb. Don't buy anything like speculative. You just get your big banks. Like your JPMs, your BACs. Like one of my favorites is M&T Bank. I mean, the way that they have managed, the way that Renee Jones, their CEO, has managed the liquidity crisis or the liquidity situation of the past 2 years. I mean, it's like the guy put on a clinic. I mean, it's absolutely remarkable the way that they manage that situation. Like, go out and buy safe stuff. Don't be crazy. Buy safe stuff that's been brought down by everything else. And then you just sit on it. You just sit on it for 5-10 years and just let it do its thing.
Okay, and I assume most of these stocks probably pay nice dividends as well.
Well, yeah, certainly they pay really good dividends when they're trading below book value. Yeah, so yeah, I mean, your typical the way banks work is that you take a third of your net income and you distribute that into dividends. You take a third of your net income and you reinvest it in the bank. And then you take a third of your net income and you invest that in growth, either doing M&A, or if M&A is not an option, you buy back your stock. So typically you're getting about a third of what they make that's coming out into your dividend.
I'll just add one thing in case for the audience. So if you're really cautious, you can also move up in the capital stack a bit. So you can buy preferred shares. So preferred shares are kind of like debt. So they have like a fixed coupon. But if something bad happens, the common equity gets hurt first before the preferred. So you get a little bit more safety if you want that.
Okay, great. I'm going to ask this question, Joseph, because I think you caught some people's attention. You said you thought policymakers were panicked right now. This guy's saying, why? What are you hearing from your insider contacts at the Fed? But if you could just clarify that comment you made a few minutes ago.
Okay, so when you are when you're distressed in the banking sector and you see over the past few days these regional bank stocks basically implode by 50%, yes, you are worried that something could happen. And of course, we're hearing more whispers from reporting that maybe the Treasury wants to do more with deposit guarantees. Maybe the SEC will ban short selling. That's them looking at what's happening in the markets and trying to do something about it. This is obviously something that's been in the focus in the news for the past few weeks. Of course, it's not red alert, but we're seeing noise that there could be movement towards some kind of policy response. And also, of course, if you don't do anything, there's a possibility that this could spur an actual panic, which is what no one wants.
Okay, all right. I am just continuing to scroll here to pull up a couple more questions. Folks, do me a favor, by the way, if you enjoy having these live topical special reports, we try to rush them to market here and do them live because they're so relevant to what's going on in the news. If you like this model, and if you're enjoying this particular conversation today with these fine banking analysts, please do me a favor and just let me know your feedback in the live chat. And of course, if it's positive enough, we'll do more of these. All right, I'm pulling this up without reading it. A question from a total novice. Can you describe the Massachusetts deposit insurance system, and can other banks and states do something similar? Not even sure what he was referring to, but John, it looks like you do. So why don't you go ahead?
Yeah, so the Massachusetts has its own deposit insurance that kicks in. So let's say you have a Massachusetts bank that fails, and that the FDIC, whatever, for whatever reason, doesn't cover all the deposits, all the uninsured deposits. Well, the Massachusetts fund will cover up to 100% of deposits. So it's kind of an additional safety net there in Massachusetts. That's I could go on about that, but that's basically the answer to that question.
Okay. All right. Well, look here. We are coming up on the hour here, and I want to be respectful of your guys' time because I know you guys are in high demand here. Real quickly, before we tell people where they can go to learn more about each one of you guys and your work, I just want to give you guys a chance to kind of just give sort of parting comments. What would be your parting counsel, advice to today's viewers who have listened to everything here and are just, what are the key things you want them to take away from this conversation in terms of the current health and status of the banking system? Joseph, why don't we start with you?
Again, I want to hit on the fact that there's this very big divergence between market prices and what's happening on the ground. The prices are declining a lot. That seems to suggest, oh my God, there's a bank run. That's not happening on the ground. So you got to keep that in mind. All right. So again, if it persists, it can totally precipitate a banking panic, but that's just not happening right now. So right now, I don't think you should panic, but it would be very helpful if prices could stabilize.
Okay. And you did just make me think of one last question I forgot to ask. I'm going to slip in here, and John, I'll let you answer this too, but I'll start with you, Joseph, which is, how would you rate the response from the central planners so far to the banking instability? So the Fed, the FDIC, the Treasury, what kind of letter grade would you give them for what they've done so far?
Oh, that's hard. All right. So
sorry to end on a hard one.
Okay, so so here's the problem here. So I think the best policy response would have been just go out and just guarantee all the deposits. But because of legislation post GFC, they really don't have the tools to do that. So with the tools that they had, the Fed rolled out this lending facility, which for the first time ever, the Fed is basically lending unsecured because they're lending on face value and not market value. Okay. Mm-hmm. And then they're basically doing the best they can given the constraints they have to guarantee all deposits. So I think they're doing a good job. So I think they're doing the right thing. And if it's not if it's not perfect, it's because they do operate under certain constraints. The Fed really made this unprecedented move on lending unsecured. I'm not sure people realize just how much of a lift that was.
Okay, John?
I'd give them a B or B minus, because they'd get, if they got an A, we wouldn't be having this conversation.
Well put.
And if they got an F, maybe we wouldn't be having this conversation either. So I'd give them a solid B. But like Adam, to kind of your point earlier, like I think you have to think about all this stuff you got to put it all in the same bucket as the coronavirus, the response to the coronavirus response. Like this stuff is just all part of that same story. You know what I mean? So it's like they probably went in too heavy when 3 years ago with the response to coronavirus. So like that gets them down from an A. When they came out and they said after Silicon Valley Bank, when they issued that press release on Saturday, said like, we're not going to cover all the deposits, and that caused those additional runs. Like, that certainly kind of went against them getting an A. So I'd probably give them a B or a B minus. But let's pretend that C. Let's not grade inflate, right? Let's give C right in the middle. So you got maybe a little bit better than average, but not horrible. But so then to answer your question about so I think Joseph's wrap up point was a really, really good point. You can look what's going on in the market and what's going on in the ground, and these are two totally different things. Okay, and I think that's a really important point to keep in mind. So I would subscribe to what Joseph said there, and then I would just add to it that, like, again, to go back to where I started, like, we've seen these things over and over and over and over again, and you know what always happens? We just always go back to just like kind of how it always was. You know what I mean? So it's like to be irrationally fearful at this moment is to forget that, like, well, we just went through one of these, like, a little over a decade ago, and look where we came out. We're in fine shape. So like, just chill, like keep your head down. If you have some excess, money, like take advantage of what's going on in the stock market while everybody else is being fearful. Like you can go out and, be a little bit greedy, and you'll make it through just fine.
Okay. Yeah. I mean, you guys, I'm sure like me, have been just bombarded with questions over the past month of like, should I be taking my money out of the bank? And, people that feel that instinct to just, get their cash out and bury it in the backyard. And, I hear you guys saying, which is nice to hear, since you guys are so much closer to this than the rest of us, is no, it's really not nearly as bad as the headlines are making it sound. In fact, there's likely opportunity here to take excess capital and invest it at these prices in some of the better banks. You'll probably get a nice return coming out of it. So guys, thank you so much for that very informed perspective. I do want to part here by letting people know where they can go to find out more about you and your work. Let's start with you, Joseph, and I'm going to use my godlike powers here to put up the URL to your website while you're giving your answer.
And thank you. And of course, I have a website, fedguy.com, but I also started a YouTube channel called Joseph Wang, where I give weekly updates on what I think about the markets. So if you're interested in my perspective, check me out over there, Joseph Wang.
Just type in Joseph Wang at YouTube.
Yeah, that's my channel at YouTube. The channel actually FedGuy1 too, but if you just Google Joseph Wang, you'll find me. In YouTube, yes.
All right, great. And Jonathan, how about you?
And let me just say that I've followed Joseph for a long time, and so I would just second that you should follow him. He's one of the kind of the sharpest minds in the space. So I didn't know you started YouTube, so I'll definitely take a look at that. You can find me at maxfieldonbanks at substack.com. And you can also find both me and Joseph on Twitter. That's kind of one of our main distribution platforms. But we love all the readers and all the listeners. So anybody who's interested in this stuff, come take a look.
Definitely check out Maxfield's Substack. It's really good. And Max has tons of experience in the tech sector, so he knows what he's talking about.
Great. Totally agree. And I really want to underscore too, for anyone that's on Twitter, you guys are two must follows. Really enjoy following you guys myself on Twitter. So highly recommend that folks go do that. Well, folks, look, so if you enjoyed this, and it seems like from the comments when I asked for feedback earlier, we're pretty positive. Please do us a favor, support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if you're looking for help and guidance on obviously just navigating this crazy time that we're in, but potentially taking advantage of some of the opportunity here that both Joseph and Jonathan talked about. As always, you can always go schedule a free consultation with one of the financial advisors that's endorsed by Wealthion. To go do that, just go to wealthion.com. Doesn't cost you anything. No commitment to work with these guys. It's just a public service they offer. Really enjoyed this hour. Thank you so much for taking the time on short notice, gentlemen, to join us for this. Clearly from the feedback here in the chat, folks learned a lot from this conversation. Really appreciate your time here. Look forward to having you guys back on the channel each individually soon. And just want to again extend my thanks, guys. This was wonderful.
It's a pleasure to be here. Thanks so much. And great to meet you, John.
Same to you, Joseph. We'll see you guys.
Is this the first time you guys actually got to meet?
Yeah. You're handsome in your still photos, but even better in life.
Thanks for organizing this whole thing, Adam. It's a great discussion.
All right, guys. Thanks so much. Everybody else, thanks so much for watching.
Bye.
See you guys.